I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong.
Hi there, I'm JB. This video is a part of my Portfolio Challenge series, where I take different portfolios and put them up against each other and see which one would perform the best. This time I'll punish the Bogleheads free fund portfolio. No, seriously. I'll look into how the Bogleheads free fund portfolio would have fared against, for instance, my ETF mix portfolio and the S&P 500. My ETF mix portfolio is shown in my video called Maybe the Best Portfolio Ever. I'll leave a link in the description so you can watch it later. So, let's start with the beginning. What are the Bogleheads? What is the Bogleheads free fund portfolio and why is it interesting? Well, Bogleheads is a term intended to honor the Vanguard founder, John C. Bogle. May he rest in peace.
We have some very sad news to share with you tonight. John Bogle, the founder of Vanguard, has passed away at the age of 89.
He was a great man who tried to make it a lot easier for the normal retail investor to get ahead. Warren Buffett used to say Jack has done more for the individual investor than the whole of Wall Street. Let's just hear Warren tell it himself.
There's one more person I would like to introduce. Jack Bogle has probably done more for the American investor than any man in the country. And Jack, could you stand up? There he is. Index funds overall have delivered for shareholders a result that has been better than Wall Street professionals as a whole. And I estimate that Jack, at a minimum, has left in the pockets of investors without hurting them overall in terms of performance at all, gross performance. He's put tens and tens and tens of billions into their pockets. And those numbers are going to be hundreds and hundreds of billions over time. So it's Jack's 88th birthday on Monday. So I just say happy birthday, Jack, and thank you on behalf of American investors.
I'm a great big fan of Jack and the index funds and the whole Vanguard system he put together. He is, or should I say was, the GOAT. The Bogleheads are investing enthusiasts who participate in the Bogleheads Forum, where they discuss financial news and theory, and they help new investors develop their portfolios. There are more than 120,000 members today. The Boglehead approach begins with deciding on a percentage of allocations to various asset classes, such as US stocks, international stocks, bonds, etc. The desired allocation is then implemented using a low-cost index fund, which are true to the targeted asset class. Bogleheads emphasize regular saving, broad diversification, and sticking to one's investment plan, regardless of market conditions. So, basically the standard sound investment philosophy. Bogleheads base their philosophy on the 12 pillars of wisdom and the Vanguard's investment philosophy. You can read more on the Bogleheads website. It has long been known that the Bogleheads portfolios are more secure and stable than most investing ideas, but hey, returns are not that great either. But please have in mind when looking at this comparison that the free fund portfolio might do a lot better in a long period of a bear market or maybe during a market crash. But again, it's all about timing, your investment stage, where are you in life, and the risk reward. So, what is the Bogleheads free fund portfolio? Well, actually it's not 100% specific, but of course Vanguard products are preferred. It assumes that you as an investor should hold both domestic stocks and bonds and some international stocks too. The task is to figure out how much each of these should be in the portfolio and typically using some Vanguard ETFs or the likes for the stock part. The most acknowledged version is the one with Vanguard Total Stock US Stock Market, like VTSMX. and the Vanguard Total International Stock Market like VGTSX, and the Vanguard Total US Bond Market, VBMFX. However, these are not ETFs, and thus they have a high expense fee, so instead of using them, I prefer using the standard ETF versions. In this example, these ETFs had not been around for so long, so I will have to use the above mentions to backtest my portfolio and get the maximum numbers of years to compare. I will note that if you should try to implement the Bogleheads free fund portfolio, you should be using the following ETFs as their expense ratios are a lot lower. Actually, you should try see my video on what these small expenses really can mean for you over time. You should use VTI, Vanguard Total US Stock Market. It has an expense ratio of 0.03%. That's 0.11% cheaper than the VTSMX and performs just the same. Then you should use VXUS, Vanguard Total International Stock Market. The expense ratio is 0.07, which is 0.10% lower than VGTSX and performs just like it. For the bond part, you should use BND, Vanguard Total US Bond Market. Expense ratio is 0.03, which is 0.12% lower than the VBMFX. And trust me, over time, these small percentages will be very important. Now, the next part is the asset allocation of each in the portfolio. How much should we have of the US stocks, how much international stocks, and how much should be bonds? Well, the most classic one is 50% US stocks, 30% international stocks, and 20% US bonds. But there can be many different weightings, and some people believe that their age should be reflected in the size of bonds. So, for instance, if you're 50 years old, bonds should be 50% to ensure stability.
Nope.
I don't agree with that. And in this example, I will use the classic 50-30-20, and I will go with the slightly more risky 60-20-20. And just for the fun of it, I will use a 60-30-10 in the last one. This is so we can get an idea of what the historic returns would have been and what this asset allocation could have looked like. So let's check it out.
Check this out.
And remember, I use the investor funds just to have the longer timeline to compare performance. So 50% US stock market, 30% global stock market, 20% bonds. Here I have compared the free fund portfolio with a variant of my diversified ETF mix and the S&P 500. And it will surprise you how much gains a simple ETF mix has produced in the last 20 years. It's a portfolio geared for growth, but also fairly diversified and in different sectors. Although it's still a stock-only portfolio. The period I'm looking at is from 2004 till today, as the oldest S&P 500 ETF in the portfolio is SPY, so I need to use that instead of the Vanguard one I would use in real life today. The timeline is only around 20 years, but still it gives us a good indication of the past performance. And yes, I know, past performance doesn't equate to future performance, but it's a very good indicator. Wait a second, let me just have a look-see. Did you hit the like button yet? I don't seem to see that. I would really appreciate a tap on that like button, so YouTube will promote this video to others. So please do it now. Just do it. Do it. Do it.
Come on, do it. Do it. Do it.
So, let's see how the Bogleheads free fund portfolio would have fared in different allocations. I have entered $10,000 as the starting amount, and the period is from 2004 till today. Drum roll, please. Ta-da! As you can see, the free fund portfolio would have had an end amount of around $36,578, which is a compound annual growth rate of 7.19%, which is not bad at all. But remember, we have a very diversified portfolio with 20% of bonds in it. If we then look at my diversified ETF mix, which by the way has no bonds in it, that portfolio would have returned around $74,524. Wait, what? That's over twice the return in under 20 years. That's 11.36% compound annual growth rate. That's very, very good, compared to the S&P 500, which returned around 52,732 and had a 9.32% compound annual growth rate.
What did we learn?
I don't know, sir.
I don't fucking know either.
The takeaway here is that the Bogleheads free fund portfolio could not outperform the S&P 500 and definitely not ETF mix with growth and tech stocks in it. So we need to think here. Will the next 20 to 30 years be more growth, tech, innovation oriented? Or will we be plagued by recessions, high interest rates, maybe market downs, bear market for a long time? I don't know. If we get a long recession or interest rates, the bond part could help us out, and the growth tech part of my ETF mix would probably hurt us in the short run. But as I always say, if you know your timeline, it's just a probability game. And my money is on tech and innovation. The longer time you have, the higher the probability of the S&P and or Nasdaq to catch up, where bonds are usually very slow to rise and fall. We can actually see that in the best year column, where the free fund had its best year with around 25% gains, and my ETF mix had almost 35% gains in that year. Worst year and max drawdown, they're pretty much the same. So again, tech, growth, innovation seem to have a better comeback, a better advantage in growing fast. If we look a little deeper, we can see that the real problem for the free fund portfolio was established during the financial crisis back in 2007 and forward. It took 3 years and 12 months before that portfolio recovered. Where my ETF mix recovered after 2 years, the S&P took 3 years and 6 months to recover. We can look into the specific ETFs per year to see which were responsible for the drawdowns and subsequent recovery. The free fund portfolio, it was the time after 2007, it simply did not come back as fast. All the other portfolios did better, and by 2013, it was hopelessly behind my ETF mix. And when you see the graph, you'll see the ETF mix pull away. When looking at my ETF mix, we can see that the technology part, the VGT, is the one making the largest returns with almost 14% compound annual growth. Number 2 and 3 are VCR, Consumer Discretionary, and Healthcare, VHT. So, what's the conclusion? Well, if you need a very, very secure portfolio with modest growth, then the Bogleheads could be a good choice. Especially the international stock part could help us if the US had a lot of years with a bad economy. However, I would argue, if that were to happen, the majority of the world would also have problems. We all trade together. Okay, I promised you what would happen with a more aggressive version of the free fund portfolio, and the 60-20-20 would only have gotten a 7.65% compound annual growth rate. It's still okay, but it's not great. And even the 60-30-10, i.e. the one with the least amount of bonds in it, would still only yield 7.73% compound annual growth. So even the S&P 500 would have outperformed the free fund portfolio. It's always a matter of risk versus reward and how long your holding period will be. Personally, I would rather have a higher risk and the possibility of higher returns. What do you think? Is the Bogleheads free fund portfolio even something to consider? Let me know in the comments. Give me some tips. Let me hear what you think. On that note, I will end the video. Remember, the best investment you can do is in you. The more you learn, the more you earn. Bye.
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I've made mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the ninth inning, there ain't no point in resisting.